part of my series on the battle of vacation rental platforms. Today, we're going to talk about Here. I've already done a video on evaluating Here as though I were an investor looking to invest in vacation rentals. Today, I want to talk about how I would think about this investment with my VC hat on of actually investing in Here, the company. And it just so happens that Here is raising on Wefunder. And so you can check them out and decide for yourself if it's something that you want to support and invest in. As a reminder, this is not investment advice. This is just purely for educational and entertainment purposes only. But my hope is that by walking you through like what's going on in my head as I evaluate this company, it can give you some insights as you're trying to think through evaluating startups, whether it's Here or others on your own, and help you make better investment decisions. All right, so let's dive in. So first of all, company's raise has $3.5 million in commitments from 3,700 investors, so a little less than $1,000 per investor. If you haven't watched my other videos, be sure to check out Arrived, where I do the same evaluation of their equity crowdfunding that they're doing on Wefunder at the same time. What's interesting is they are raising a lot more money, or have commitments for a lot more money, to the tune of like $33 million, but it's a little bit like disingenuous because $25 million of that was raised last year by larger institutional like investors. And so really they've got commitments for a little over $8 million. But that's still almost, it's more than double what Here has in terms of commitments. Going down through here, we've got their valuation cap. So what they're doing, so for future equity. So what they're doing is they're raising a SAFE, which is a simple agreement for future equity. I've done other videos on what a SAFE is, so be sure to check those out. But in this case, the real short on this is that a SAFE is kind of like a convertible note. You're making an investment today, not for equity, but for the promise of equity in the future. And they have a cap, which means that whatever they raise valuation-wise in the future, the maximum that your money will be invested at is at that $30 million. It gives you some protection. Let's say that Here ends up being wildly successful and their next round they raise at a $100 million valuation. Well, your investment would convert into equity in the company at a $30 million valuation. And so almost immediately your investment would triple in paper value. So that's what the SAFE is. Compared to Arrived, this is a much cheaper valuation. Arrived is raising at a $100 million valuation, and this is basically at a $30 million valuation. So that's interesting. You also have some downside protection that you're not getting with Arrived. And in that case, because it's a SAFE, it could be that they end up raising at a lower valuation. So let's say they raise at a $20 million valuation. Well, in that case, you would also convert at $20 million as well. Whereas if you invested in Arrived, you'd invest at that $100 million valuation. And let's say their subsequent valuation was at $50 million, then your investment would actually drop in half in terms of paper value. So just something to like think about in terms of the valuations and the different structures and the different types of securities through which you're investing. Here is essentially like a kind of like a convertible note. It's a SAFE, and Arrived is actually just pure equity. All right, let's look through some of their highlights. So number one highlight is that Mucker Capital, Liquid 2 Ventures, and Fiat Ventures are investors. I know the Mucker guys, they're great. They're really good investors. Their strategy is a really interesting one. They're a seed fund, but they don't invest in like 100 companies like most seed funds do. They invest in just a handful, and they invest relatively large checks, and then they roll up their sleeves and the whole team gets behind that company and tries to help them. So they take very concentrated bets, which means that they have to have a really high batting average of companies that ultimately are successful. And so that's their strategy. So the fact that they're invested here, I think, is a strong sign. It means that you're getting like a lot of support from the Mucker team, and that they are huge believers in this company because they have to be really picky. Liquid 2 Ventures, you probably have never heard of them, but that's actually Joe Montana's kind of fund or investment group that he manages with some professional investors as well as his son. And they're in a lot of great deals. That's great. And then Fiat Ventures is an interesting one. I mean, this is Fiat, the auto company. Not exactly sure why they're an investor, but interesting. 90,000 total users on their wait list. So that's interesting. I don't know why they're on the wait list. I would just assume that they'd open that up for anybody to participate. So I'm not exactly sure why that's like a wait list, but interesting. Okay, 90,000 is a lot of people. For comparison's sakes, and you're going to hear a lot of comparisons to Arrive just because they're so similar. It's about a third of what Arrived has. 10 million AUM, and that's about a tenth of what Arrived has. So Arrived is definitely, by an order of magnitude larger than here, but that doesn't necessarily mean that they're better. It just means that they're larger. Plan to launch in 25 markets by 2024. CEO scaled his prior company, Homeworthy, to 900 plus cities, but what happened to it? They've raised $5 million in venture capital, and then they've been featured in a bunch of places. Okay. If we look at the team, so he co-founded Homeworthy, venture-backed, fully remote cloud real estate brokerage that served homeowners across 900 cities across the Pacific Northwest. Okay. My guess is that Homeworthy did not do well and actually went out of business. I could be wrong, but usually if it had a successful outcome, he'd be bragging about that here. And I know there's a lot of companies that have tried or are trying to do what he's doing with very little success in the market, frankly, or very mixed success. So, I mean, look, he's been an entrepreneur. He started something, even though it didn't go well, like he's kind of been there, done that, which I like. I just wish, and it's more like industry relevant experience, which I like. I just wish that maybe he had a successful exit there. And then he's got Caleb, used to be Senior Vice President of Technology at Evolve. Evolve is an interesting, really interesting company. So yeah, I like his experience there. And probably relevant because Evolve does a lot in like the fintech space. Previously acquisitions at Divvy Homes, 17 years of real estate experience. Okay, so that's interesting that, he's got a decent amount of experience there. Previously investor operations at Angel List and the customer experience at Divvy Homes. Okay, so that's cool. I think I've actually talked to Tucker. Yeah, I mean, that's relevant experience to an equity crowdfunding platform. I feel like this team is like good, but not like absolutely amazing. I wish there were like maybe a little bit more here around marketing, because I feel like this at the end of the day is like really a marketing play, and understanding consumers who are your investors really, and getting them onto the platform and doing that cost effectively and building a really great brand. Like all of those things I think are really important. The other thing too that's not here, and they probably have it on the team, but I just wish they talked about it here, is somebody to help with, that has a lot of experience in property management, because here does their own property management. And so I'd really want somebody that's like really good at operations, has a ton of experience there on the team and highlighted. And I just don't see that. So those are some of the holes. I think the other hole is like, this is an equity crowdfunding platform. I don't see anybody here that really understands that outside of maybe Tucker. But his experience looks like it's more like customer oriented. And I think I'd want somebody that's a little more finance oriented. Like I feel like they need to have like a pretty decent CFO who can handle like operation, like financial operations and risk management and some of those other factors. And I'm just not seeing it here. So here they go talking about the platform. Really what it is they just democratize access for as little as $250. You can invest in short-term rentals, which I think is great. Why it's broken. Cap rates are rapidly shrinking. Investing is time consuming and challenging, and financial barriers high. Okay, that's fair. I agree with that. I think that's why this is ultimately interesting. So annualized return of vacation rentals is rising. Yeah, I tend to agree with a lot of these things. It's great. Like, you invest, we handle the rest. The real question is like, what do they charge for that? Here they've got their competition, and they're missing like one really big competitor. Arrived Homes, not here. I would argue same value prop, high ROI and easy. Also, I would like to know how they are defining high ROI, but maybe they cover that. Fully passive experience, blah, 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 business model. Okay, so here's the business model. This is where it gets interesting. This is how they make money. So dedicated team meaningfully driving revenue day one. So they have a sourcing fee based on the total value of the property offered on the platform, varies property to property. This fee covers services such as acquisition, onboarding, investor aggregation, underwriting. Okay, so if you saw my other video where I do a breakdown of what you're paying for the service, now let's talk about it from the opposite side, which is you're benefiting as an investor or part owner in the business from these fees, and this is what counts for your revenue. So in my other video, like going through it, I identified that they are pulling roughly 50% of the annual value, the gross receipts from the businesses that they invest in, assuming that they hold a property for 5 years. But if you take that out and you just say, well, how does this come out to revenue? So the sourcing fee, the property we looked at was a $1.4 million total offering, but the property itself was only worth $816,000, and they were charging over $200,000 in the sourcing fee, which to me is like very aggressive, right? You're talking like 20%, or in, 20% of the value, right, is just like in their pocket as their sourcing fee. That feels really high. And then they have their asset fee on top of that, which is another, call it 14,000, somewhere between 8 and 14,000. It was a little ambiguous, but I think it's like 14,000. And then they have their property management fee, so where they're collecting 25% of gross revenue, and that's like their ongoing recurring fee. I will say that I really like both the asset management fee and the property management fee of 25% because that's recurring revenue to the business. And as long as they own that property, they're going to generate that revenue. And so it ends up being like really nice revenue from like a forecasting and stability perspective, similar to like SaaS revenue, which is like really attractive because it's predictable and so forth. So those are all great from like a revenue perspective and as an investor. And clearly like the people that are investing in these properties on their platform, either they don't know that they're paying out like 50% of the value to this company, or they just don't care because they don't have access to this asset class any other way. And so like ultimately that's fine if people are still willing to invest and they're excited about this, then that's fine. That's what they're paying for, right? And as an investor, that's great that you're actually making like real revenue at good margins. Don't see anything around financials. So that's a big question mark, is I don't know what they've done in terms of financials. In 23 our goals. Okay, so this is what they hope to achieve. Yeah, I wish they had more data on what their revenues look like. But let's do this. Let's go to here.co. And let's see if we can estimate what their revenues look like. So we go to properties. They have done 13 properties. So let's say that their typical property, if we look through here, offering amount 800, 600, 700, 800, 850, 500, 500, 1.2, 400. Let's say that on average, let's look at these. Let's look at this property. Let's look at the circular. And then we'll go to use of proceeds. Okay, so offering amount was about half. Did they use and then they borrowed a big chunk of that. Okay, so their service fee was $129,000. Okay, so at $129,000, let's say that their average is about 100, and let's just say let's say it's 100,000, because a lot of their properties aren't very big or very expensive. Although they are financing them, so yeah, let's say it's about 100,000. They've done 13 properties, so that would be one of them still raising, so we'll take that one out. So that's 12. So let's say it's 1.2 upward, somewhere between 1.2 and $2 million in revenue. Let's say that they generate somewhere between 1.2 and $2 million in revenue, and they're raising at a $30 million valuation cap. That feels expensive. I mean, you're roughly paying somewhere between 16 or 15 and 20x enterprise value to revenue. Arrived is at about 16x, but Arrived is a lot bigger and more established, so I'd expect them to get a higher valuation than here, all things being considered. I feel like this is a rich valuation, honestly. That said, like 30 million isn't like crazy. It just means that you're paying up on valuation a little bit early. The benefit though is because it's a safe, if they end up raising at like a more reasonable valuation, like I would expect something closer to like 15 to 20 million, you'll get that benefit because you'll just convert at that lower valuation at that time. So, yeah, I don't know. The valuation I think is rich, but it's not like the biggest hang up because you do have that downside protection. Yeah, I mean, overall, like those are the things I think about this deal. Like, I think this is a big market, big opportunity, solving a big pain point. I think the team is okay, not great. I think what is interesting about this deal is because they charge so much up front, that's like guaranteed revenue as soon as they close all the investors into the deal. And they don't have as much risk on the back end as Arrived does in terms of like, varying rental income rates. They do get impacted by that because they're the property manager. So that's going to impact that 25% that they're generating every year from those services. But that's probably relatively low margin services anyways. And that most of the margin and most of the opportunity is when they actually sell the property to investors on the front end. So I like that. The problem with that is it's a one-time revenue. And so they're not getting that year after year after year. They got to go find another property and then convince investors to come on and fund that property in order to generate more revenue. Whereas Arrived backloads a lot of it so that they're generating a lot more like recurring revenue and off of the rental incomes in later years. And generally like one-time revenue is going to be valued a lot lower than recurring revenue. So I could see why, Arrived would do that. But it is a little more risky because, people could decide that they're not going to stay at Airbnbs anymore. They all want to stay at hotels all of a sudden. And all of a sudden, like, Arrived could be in a tough spot where they're seeing like their rental income decline. So yeah, I don't know. I think this is like interesting. Largely, I have a thesis around company, like this whole democratization of access to alternative assets and investing, which is why I wanted to do a video on this, because I think this whole industry and trends are super interesting. But yeah, what do you think of this investment? Do you think it's something worth investing in or not? What are the risks as you see them? Hopefully this process has been helpful to you in terms of seeing how like a VC would evaluate this and think about this as a potential investment. If you enjoyed this video, be sure to check out the other ones in this series, the battle of the vacation rental platforms. Thanks.